Hello, this is Keith Porter with Showcase Realty, and I am the realtor with the heart of a teacher. Today, I am joining you to talk about the May 2024 housing market update. And, with the Fed meeting last week and the jobs report and everything else coming out, the big thing today is going to be on where our rates going to be. So let's talk about that. What's the latest on rates? Well, latest, according to the senior economist at Zillow, is we are seeing volatility and there's a lot of up and down, and you'll see that in the next slide, but we're going to have to talk about the reason for this volatility. So here we see the daily mortgage rate going all the way back to October of 2023. So we see that it was at 7.6% right there at the beginning of October. And then before November, it went into the 8%, which was a kind of scary time, wondering if the housing market was going to crash. It didn't, by the way. It's just in a state of flux. So they were able to bring it down, and we got it to the 6.6 range right there to end the year out. But then it started rising again in January. And you can see all the ups and downs, the dips and valleys here. But even last week, we had about 7.5%, and now it's dropped down to the 7.3%. So a lot of flexibility. And we want to know why. What's causing that? Well, I'm here to tell you that mortgage rates are influenced by many elements. So, the inflation rate, pace of job creation, whether the economy is growing, shrinking, even geopolitical actions have, um, even geopolitical events impact this. And of course, the Federal Reserve's monetary policy. So, the Fed does not set mortgage rates. This is something a lot of people have to understand. The mortgage rates are set by banks, but it's indirectly influenced by the Federal Reserve's monetary policy. So what the Fed sets are the rates that banks pay each other when they're borrowing money. So of course they're going to add a premium to that so that they get money off of the interest whenever they're buying or when they're loaning you the money. But that is um, the relationship between mortgage rates and the Fed's rate. It's kind of a inadvertent effect. So the latest Fed decision that came this last week, they decided to maintain the target range for the federal funds rate at 5.25 to 5.5%. Didn't go up, didn't go down. It just stayed. And the reason they gave for that was that the U.S. economy added fewer jobs than expected in April, while the unemployment rate rose. So non-farm payrolls increased by 175,000 on the month, below the 240,000 estimate. And if you don't know, the non-farm payrolls are just the number of people in the workforce who are actively in industry, like not the farmers, not the self-employed, not the ones who run their own businesses. It's the actual people working in the trade. So unemployment rate ticked higher to 3.9% when they expected it to stay the same. And it's kind of been staying the same for a while. Like this is the unemployment rate going all the way back to January of 2020. If you recall, it skyrocketed right there around the April, May time because everyone was shut down for the pandemic. We were able to get it back under control towards the end of that year. And then from July 2021 on, we've been below the historical average of 1948 to 2023. And it's been at, of course, that historical average, you can see with the dotted line, 5.7%. And we've just sat there. So there hasn't been a lot of up and down over the last 2 years, really. But the fact that it did go up just had the Fed a little bit concerned. So what was the reason for that? Well, inflation, they say. So again, same time period, January 2020 to now, inflation was at its lowest whenever we were stuck at home during the pandemic and they needed money moving. But then it went too far right there in May 2022, June, July. It went all the way up to 8.9%. So the Fed had to step in. They had to start doing things to make sure that inflation could be cut down because our target rate for inflation is 2%. I mean, that's 4.5 times what they wanted it to be. Now we got it down. It's not where we want it to be. It's still above 3%, but that's where we're concerned. So the chief economist, Mortgage Bankers Association, said that the Fed did not change the federal funds target at its May meeting. And incoming data regarding the strength of the economy and the inflation, it's resulted in a shift in the timing of a first rate cut. So we've been saying for, since last year that rates are going to come down, and or they want to bring it down, but the problem is that things keep getting in the way. So they still expect mortgage rates to drop, just not as fast and not as much. So when the Fed drops rates, they do it in terms of something called basis points. And people ask me all the time, what is a basis point? So let me go ahead and put it in here. It's a unit of measure for interest rates and other percentages in finances. 1 basis point is equal to 1/100th of 1%, or 0.01%. In decimal form, of course, it's 1 basis point appears as 0.0001. So when we're talking about the interest rate and we say basis points, I like to turn it into money and think of it in terms of pennies. So if you're dropping it by 1 basis point, well, that's 1 penny, 0.01%. And here's another way to look at it. 1 basis point is that 0.01%, 5 is 0.05, 10 basis points is 0.1. So if we got to 100 basis points, just like if we got to 100 pennies, then of course we would drop an entire percentage point. So that's my teaching nerd side today. So if we look back, whenever inflation was getting dangerously high there in March of 2022, we see the Fed take action. So they increased rates by 25 basis points. May came around, 50 basis points. Then June, July, September, November, 75 basis points. That's when the mortgage rates were going up, right? It wasn't fun anymore. So buyers started to tighten up. Banks were tightening the purse strings. Now, December, they increased it. And then we had all through 2023 where they raised it minimally in February, March, May. Didn't do it in June, but then they raised it again in July. So we had this point from September to now where each time they've met, they left it the same. They've kind of said we're trending in the right direction, but we don't want to make a change right now to mess it up. And people always want to know why, like, let's fix it. Let's lower it so people can buy more houses, right? That's what they want to do. But the problem is that reducing it too soon or too much could result in a reversal of progress, like they've seen in historical data. So if you were alive during the 1970s and noted or saw the inflationary time that they hit then, in this first period right here, this first peak, it mimics what we see today and what we've had in that second oval on the right. But the Fed jumped in too soon and too fast. And then instead of maxing out just over 12%, it went up above 14%. It took longer to get down. You can see it took that whole decade for inflation to get under control. So it is important that we learn from history and we don't move too fast. Now, will there be rate cuts? Jerome Powell, the chairman of the Federal Reserve, says that his forecast will be that we will continue to see further progress on inflation. He doesn't know if it'll be enough. He doesn't know if it's not going to be enough, but he's going to let the data drive them and not the taxpayers who are saying cut the rates. So a lot of experts are in there and they all talk about what's going to happen at the next meeting, the next one in September, when the banks meet and they are looking at cutting basis points. These are what the experts say right now. So there's pretty much a 69.6% chance that the Fed cuts rates at September meeting. So 30% chance that there'll be no change. But these numbers are always changing. So if we look from beginning of April on, these were the odds of September cut changing. 89.8% April 1st, they thought that September would bring a drop in rates. Then 3 weeks later, we have 69.8%. Last week, the day before we had the meeting, 45.9%. And then it's even now, the day that the Fed had that meeting, it went up to 53.8% for September. I guess people started thinking, well, it didn't happen now, it'll happen in September. And now it's 68.3, 69.6. The point is that this is speculative. People don't know. We expect it's going to get cut, but we can't say when. It depends on a lot of things. Now, some could say, well, it could go up, but we do have soft assurances here from Jerome Powell that he thinks it's unlikely that the next policy rate will be a hike. So here's what 3 of the big names in mortgage rates say. And of course, I did videos last year that didn't pan out, but I will look at the last column here with the average of all 3. So they're saying at the end of quarter 2, 6.83%, quarter 3, 6.63, quarter 4, 6.43, and then into quarter 1 and quarter 2 of 2025. It'll keep going down, but it's still going to be above 6%. So if we look here, these are the rates and projections of the mortgage rates going all the way back to quarter 1 of 2018. So if you look the up and down, we're still going to move down. So people who are waiting on the edge of the market saying we're going to move down, like, that's great. But I mean, people are always saying it's going to go down. This is the percent of respondents when asked if the mortgage rates would go down based on each month that they were asked. Like, we have, now that it's higher, people keep saying that it's going to go down. But here's what I want you to really pan out or really think about. What does it mean for you, whether it goes down or not? If you're buying a home in this market, we hear all the time, the rates are awful. We need to stay away. Let's wait till the rates go down. And real estate agents always say, date the rate, marry the house. And when we say the best time to buy is now, we're not just trying to sell houses. There is fact behind it. And here's what I want you to look at. I put this together. This is based on the average sales price in Charlotte right now is about $400,000. So I said, if you were going to finance $400,000 at that 6.83% that they're talking about ending the second quarter on, and then 6.63% for the third quarter, 6.43% for the fourth quarter on a 30-year rate. And this is not taking into account any down payment or anything else. This is based off of just the rate and the amount financing. So if you did that full amount at the end of the second quarter at 6.83%, your payment's $2,615 a month, $2,615 a month. If you were to wait 3 months to the end of the third quarter, where if it was 6.63%, that same amount, $2,562 a month. I mean, that's the difference of $53 a month. Like, is $53 a month going to kill you? Now, over the course of 30 years, that's the difference of $19,000, but you don't see that in the monthly payment. So let's look at this. 6.43% would be $2,509. I mean, that's the difference of another 53. So the difference between 6.83% or 6.43%, a difference of 40 basis points, is only $106 a month. Like, is that enough for you to wait right now? And because the truth is that when rates come down in the second half of 2024, even though they're going to remain above 6%, even a modest drop in rates will bring both buyers and sellers into the market. So here's what that looks like. When we have interest rates at a specific point, buyers trend to do something on this chart. So when we had rates at 6.75% right there at the beginning of January. It You had people that were kind of limited, and now that it's went into February and March where it went up, you have people that like demand is weak. So buyer demand changes with the interest rates. So if you are able to handle that extra 50 something dollars a month on your payment and get the house you want with less demand and multiple offer situations, you will come out on top. Now, I am not a financial planner. I am not the person to talk to. You can talk to your loan officer, you can talk to your tax person, whoever you need to that is an expert in your financial life. But I can tell you what goes through the mind of buyers and sellers. When the interest rates are too high, they stay back. They're all waiting for the interest rates to drop. And that's going to be detrimental if you're hoping to get a good deal. So I hope you enjoyed this market update. Just know that when you're choosing a realtor, just remember this, that most agents know what's happening. Good agents understand what's happening. Great agents can explain what's happening. So make sure that you're choosing a realtor who can explain to you what's going on in the market and help guide you along the path and make sure that you get the house at the payment and terms that you want. So if you're interested in that in the Charlotte market or surrounding areas, give me a call. My information is on uh, my information's in the description below. You can call me, text me, email me. Um, I'm open to anything. You can DM me. I don't care what you do. Leave a comment. I'll call you back. But make sure you're getting somebody who can help you. All right, that does it for now for our market update. Thanks for joining us. I hope that you found value in this, and I'll see you next time.